Hello everybody and welcome to this webinar dedicated to trading strategy and more specifically about risk management. A few weeks ago we talked about Forex. It was an introduction to Forex and then CFDs, and then I made a webinar about MT4, presented all basic manipulation about MT4, and today a webinar dedicated to risk management, which is the big part of trading strategy. Introduction. Risk management is key to elaborate a sustainable trading strategy. I mean by sustainable trading strategy, long-term profit. The ability to make profit over a year, over 2 years, because it's not so difficult to make profit on 3 months, 6 months, but on the long term, it's another piece of cake. So if you want to elaborate a sustainable trading strategy, you have to manage risk management. So first of all, circumstances and pairs you should avoid to control the risk, how to control your exposure, how to manage your profit and loss ratio, this is a risk ratio, and then two short case studies about trades of our real clients, and to finish a conclusion. But actually I'm gonna finish with a presentation of some statistics. So to avoid, first of all, major economic news. Why? Because of the volatility. It will strongly increase the volatility for 5 to 30 minutes, even 2 hours, depending on the economic news. It can create a very strong impulsion from 50 to 200 pips, but once again it depends on the economic news. If it's a surprise for the market, if it's a big surprise, the impulsion can be very, very strong. But if it's not a surprise, if it's equal to the consensus, to the forecast, the impulsion will be very weak. And also, sometimes major economic news can be tricky. Could be tricky because of up and down effect. I'm sure that you spotted this kind of effect. Sometime, just after a major economic news, you can see a bullish impulsion and then a bearish impulsion. This is the up and down effect, which is very tricky, very difficult to trade, and dangerous, especially for retail traders like you and me. First example on Euro USD, you can see on the bottom left. On the left of the chart here, you can see it was a consequence just after the unemployment rate update. So first effect, 50 pips up. Okay, you can see the first impulsion here, and then a down impulsion, a bearish impulsion, and then 50 pips down. This is the up and down effect. Very difficult to trade. For retail traders, it's practically impossible to trade, except if you have a very big capital. So try to avoid this kind of major economic news. A second example on the Kiwi, NZD USD, so dollar from the New Zealand and the US dollar. So here you can see a very strong bearish impulsion. Just after the interest rate decision, you can see an impulsion of 100 pips down in less than 10 minutes. So once again, the volatility was very high, so very dangerous to trade, very difficult to manage the risk in this situation. So we talk about circumstances, major economic news. Now let's talk about products. Try to avoid emerging and exotic pairs. Why? Because once again those pairs are very volatile. The volatility can be very high. I know that some investors may prefer the challenge of speculating emerging currency pairs because they correlate with the economies of developing countries. Can be Brazil, Russia, India, China, South Africa, Turkey. Very interesting economy. They are in a strong growth, but they are a bit too sensitive. Their currencies can be very volatile. The volatility can be very high, and those currencies are very sensitive to international instability. First example with the Russian ruble. You know that in Ukraine it's quite unstable, so the Russian ruble is quite volatile those days. An example now with USD Turkish lira. And this is an example from last year, and it was in 2013, and here you can see a huge volatility. In 3 days, you can see a first movement here, 2,200 pips down. First movement, bearish, very bearish, 2,200 pips down, and second movement, 1,600 pips up. So once again, this time a down and up effect. Quite impossible to trade, even for big companies or institutional. It was very risky circumstance. As I remember, it was correlated to the political instability in Turkey last year, after some protests in Istanbul and Ankara, and so the pair USD Turkish lira was very volatile. So let's remember the second point. Those pairs are too sensitive to international instability. So try to avoid this kind of pair. So volatility is too high to properly manage your risk. A second example on USD South African Rand. Once again, it's in 3 days. First effect, first impulsion, 313 pips down here, and second effect, 470 pips up. Once again, a down and up effect, very difficult to trade. The volatility is not in thousands pips, but in hundreds pips, but it's still very difficult to trade. Once again, if your priority is to manage the risk, and I think it should be your top priority, try to avoid this kind of pairs. Now let's talk about exposure. Basically, the exposure is the ratio between the balance and the margin. Mobilize 25% of your capital maximum. This is an absolute maximum, but usually try to not exceed 12%. Okay, the average should be around 12%. Two examples. With a balance of $2,000, the margin is $500. So the ratio is 25%, which represents 0.5 lots on GBP USD and 0.5 lot on USD Yen. 0.5 lots on GBP USD, it's 250 pounds, and 0.5 lot on USD Yen is $250. So the total is close to $500. Another example with a balance of $10,000. This time the margin is $2,500, which allows you to open 5 lots of Euro USD, which represent $1,250, and 2.5 lots of USD Swiss franc, the Swissy, which represent $1,250. So once again, the total is close to $2,500. So once again, 25%, it's a maximum. Usually try to not exceed 12% if you really want to control your exposure, and then if you want to control the risk. And then the risk ratio. Actually, the risk ratio, this is the ratio between take profit position and the stop loss position. And also make sure you set a stop loss. It's almost mandatory in day and swing trading. I know that some swing traders don't set any stop loss because they are staring at their chart, so they can control their trade direct. But in my opinion, it's mandatory for day and swing traders. But this ratio, you can adapt it to your behavior. If you are aggressive, you can select a ratio around 2. And if you are cautious, you can set a ratio around 3. So you can adapt the ratio to your behavior if you are an aggressive or cautious trader. Also, you can adapt it to your trading style. If you are a scalper, it should be around 1.5 and 2. In day trading, around 2.5. And in swing trading, around 3. And also you have to adjust it to your chart configuration depending of the position of your resistance and support. For example, if the exchange rate is equidistant to its resistance and support, it will be quite difficult to respect a good ratio. So now I'm going to show you something on my platform. It's about the risk ratio. I'm going to present a very useful and simple customized indicator, the risk ratio indicator. So I'm going to select it, the risk ratio, this one. So let's say that you want to go short on GBP yen. So if you want to go short, you have to set your stop loss over the current price and the take profit below the current price. So here you can see I set my stop loss 35 pips over the price and my take profit 76 pips below the current price. So here here my risk ratio is 2.26. So sorry, it's quite a very good ratio if you want to go short in day trading or even in swing trading. For day trading it's quite perfect, but for swing trading it's a bit aggressive. But anyway, it's still a good ratio to take the opportunity to go short on GBP yen. Okay, actually no worries about all details about this indicator. I'm going to make a webinar fully dedicated to this indicator, the risk ratio. Okay, and as I wrote, a nice and simple tool to display the risk ratio on your chart. But this is a topic of my next webinar. Now to short case studies, to real example. Actually it's confidential, but it's two clients from GKFX. So let's call the first one Mr. E. Okay, so Mr. E had a margin call after 40 days and 56 orders. So he made a loss of 98%, let's say 100% because of the margin call. Why? Because he didn't set any stop loss and his exposure was really high, 50%. It was really high, too high. Knows the exposure, the ratio between the balance and the margin. So basically, this guy was taking too much risk and didn't want to manage the risk. So he had a margin call after only 40 days. Now, a good example, Mr. B, still trading after 85 days and 223 orders, and is currently making a profit of 12%. So I'm sure you are not impressed about the profit. 12% on almost 3 months, it's not high, but at least the guy is still trading, is, in my opinion, making good profit. 12%, it's 12% on 3 months, it's 4% a month, and in my opinion, is still a very decent profit. He's still trading, he's still making profit. Why? Because the stop loss is always set and the risk ratio is respected. Is using a risk ratio between 2 and 3, depending of the pairs, of the chart configuration also. But anyway, he is respecting a good risk ratio and also is not exposing too much money. Basically, his exposure is good. The ratio between his balance and margin is 12%. So it's equal to what I show you here. Usually 12%. So in this case, his average exposure is very close to 12%. So it's perfect. The guy is controlling his risk and is not taking too much risk. So in my opinion, it's a very good trader, still trading and making nice profit. And then to finish the conclusion, so the key sentence of my presentation: set a strict trading strategy. And now you know that risk management is a big part of your trading strategy. And the most important, if you set a strict trading strategy, respect it. Because I don't know why some people are able to set a very good and strict trading strategy, but they are not able to respect it. I don't know, because of emotion, because of adrenaline. So try to control yourself and respect your own strategy. Risk management as a priority, even more important than technical analysis, in my opinion. And risk management is essential. It's the key for long-term profit. Now let's finish with some statistics. On the left you can see the chart. In blue, winning, and in red, losing. So most of the time you can see that retail traders are closing profitable orders. So usually they are taking the good decision. They are in the good trend. But on the right, you can see that their average loss are the double of their average profit. You can see the average on the right here. Average loss 94, average profit 52. So it's quite the double. Why? Because they are not respecting risk management. So the conclusion is most of retail traders are good technical analysts, but they are not good at risk management. So once again, I think that you understand why I wrote risk management as a priority, even more important than technical analysis. Next webinar next Tuesday. So next Tuesday, so the 7th of October. And as I told you, the presentation is dedicated to an exclusive indicator for MT4, the risk ratio. An indicator will help you to manage risk management. If you have any question, any comments, don't hesitate to contact me through friends@gkfx.com. You can see at the bottom left my contact details. Well, hope you enjoy this webinar and see you next time. Bye-bye.